Eddie, I really want to talk about the latest Mike Wilson research from Morgan Stanley, because he has said that this rally reminds him of 2019. But I just pulled up on my Bloomberg terminal what happened in 2019, almost a 30% rally. It ended badly in 2020 because of COVID. But here's a man who's been expecting an equity market sell-off, and he's comparing this market to a very strong rally, one of the best years for the equity market. What do you make of it, Eddie?
Yeah, absolutely. I thank you for sharing that piece of research because it's fantastic. I really liked it. I had a glance at it a minute ago, and you know what? I think what he's trying to get at here is that we are in a late cycle economy. Now we've got to think back about what 2019 looked like. People were expecting the end of the economic cycle at that point as well. We had a lot of recessionary signals. We had an expectation that a bear market was going to follow. Now, what nobody predicted, or very few people predicted, a COVID and a global pandemic, but there was expectations that we were late cycle anyway, that interest rates had gone too high, that there would have to be some sort of equity payment. Late cycle rallies are really interesting because they tend to be, they tend to get thinner. Some sectors tend to outperform, others tend to struggle. And I think if that's the comparison he's making, I think it's a very good one, because I think these are very difficult markets to invest in, exactly because volatility is rising and we don't know what to expect from policymakers next.
Doesn't it also tell us, though, Eddie, that in order for the party to end, there needs to be a shock? There needs to be something, because last time it ended, it was because of COVID. It wasn't simply an economy that eventually ran out of steam.
Yeah, look, it depends on whether we are late cycle or not. And I think these things, they are difficult. They can't be answered in advance of the events, right? We have to wait and see if a recession follows. Then we can say, well, that was clearly late cycle, because late cycle tends to, the indicators for a late cycle, the leading indicators tend to be noisy. Things like your PMIs, they call a lot of recessions, and then very few of those recessions actually emerge. Now, so we won't know whether now is late cycle until we see the post-rally crash, as it were. We would be very, very, very unlucky as as humanity to suffer another ending to 2019 like we did. But I think it's not beyond the realms of the reasonable that we're heading for a recession, and I think that's what he's trying to get at here.
Yeah, fair enough. I mean, it does feel like he's had to kick the can down the road a couple of times now when it comes to that recessionary call. Eddie, we can't let you go without talking about the BOJ. This morning, an unscheduled bond buying operation. We've seen the market start to test their boundaries. Yields moved up to about 60 basis points. They stepped in there. I wonder where the next place they step in is, Eddie. Are we going to get a move at 70? It's an unknown, so I'm not actually asking you that. But what does it mean to trade these markets when you do see the BOJ starting to wade in these waters and start to defend some of these ranges?
Yeah, Dani, it's exactly this kind of mixed signaling and lack of clarity that makes these markets feel like late cycle, whether they are in fact or not. Because, when you've got clear policy guidance from the Fed, from the ECB, from the Bank of Japan, you know what's coming down the road. You don't have to react to every data point. If you don't know where they're going to step in, if you don't know what the Bank of England is going to do when they meet later this week, you have to react to every data point that comes in. And that increases the volatility in markets. It makes it more difficult to trade. It also increases the opportunity for the wily to generate alpha. So it's very interesting markets to trade, but only if you've got the wisdom to navigate the waters, as it were.